Hey everybody, welcome. Thank you so much for joining. My name is Matthew. Today we're going to talk about why there was no real price inflation after the global financial crisis. That is because of the Fed's policy of interest on reserves. Okay, so here we are again where we left off yesterday in my last video. Global financial crisis. The whole world went to hell in a handbasket due to mortgage-backed securities, excess financial engineering, and excessively low interest rates, as I showed you before the crisis, and now they have to lower again during the crisis. And among many other reasons, but those are the core ones. And as I talked about yesterday, perhaps an implicit bailout that the banks were, feeling comfortable about, feeling that they would have gotten anyway, which they did, because you see that the way that they were lending to each other, that is the Fed funds effective rate, this yellow line, the yellow line here that my mouse is pointing to, was well below almost 1%, 0.8%, 80 basis points, at times below the target rate for many, many weeks during the thick of the crisis until the Madoff Ponzi exploded the financial system even more and the Fed dropped interest rates to zero. And they got the monetary stimulus, that is low interest rates and excess reserves, that they were hoping for. The big question, and I've alluded to it a lot, I'm sure I've said it in some videos as well, is as the Fed started to explode their balance sheet, again, reserves were, a few billion, 10 billion here, 20 billion there, depending on the week, even all the way to when Fannie and Freddie went into conservatorship. And the balance sheet itself was no more than 900 billion, no more than $1 trillion. Once this balance sheet exploded, and this is QE1 right here. This is QE1. I'll zoom out in a second to show you again, QE2 and 3. Talked about this a lot. But with such an explosion in the base money supply, which this is, and the reserves are the core of that as far as the banking system goes, basically whatever's in the light green here is cash and coin, actually just cash. In this case, this is just the Federal Reserve's balance sheet in the United States. They don't control coin. That's the purview of the Treasury. In many, many central banks around the world, they do control coin as well, but nonetheless. The Federal Reserve note that you know and you hold in your wallet or your purse is in the light green. The majority of the light green is the Federal Reserve note. Anyway, reserves explode, causing the balance sheet to explode. In any other case, eventually, this monetary inflation would cause massive price inflation. I've already talked about this before. A rising supply of money, all else equal, will cause the price of that money, i.e. the exchange rate, to fall. And when you say the exchange rate is falling against other goods, that is called price inflation. So all else equal, this would have been a massive price inflation period, even with what happened here in 2008, after all the cascading collapses of the banks, money market funds, Madoff. Yet that didn't happen. And why not? Well, it's because if you look at these two lines here, which I've added, this is interest on required reserves and interest on excess reserves. These are the reasons. Okay. Now, the Fed thought that they would be fancy and have two different interest rates. This lasted about 5 weeks. So just after the worst of it, but just as the stock market was going to have its worst day, just before, they added these two tools, as Ben Bernanke always used to say. We would look into our toolkit and we would fix the economy. Interest on required reserves. Okay, let's start with that one. So this is very close to the Fed funds rate, but they targeted it originally just under the Fed funds rate. You see the Fed funds rate at the time was 1.5%. They put interest on required reserves at 1.4%. The idea there is that as as you do, even here, this was the required reserve amount. I've shown this in the M0 vault cash demand deposit videos. What makes up the banking system's reserves? The main thing now is this dark green portion of the balance sheet. The other thing, which is not on this chart, is vault cash. So that's actually physical notes and coin that is inside the bank's vaults. Those are the two primary reserves that banks have to loan against. And a general rule of thumb you've heard is 10%. That's actually only for large banks in the United States. Many banks around the world have lower reserves. Some have higher. Some don't have reserve requirements at all. It's for large banks, traditionally, city banks in the United States, it has been 10%, but that even has changed in the last couple years. Nonetheless, you add up this dark green, the reserve balance. You add up vault cash, which is now a very, very small proportion. It used to not be such a small proportion, but now it is a very small proportion of the banking system's balance sheet. And those two numbers together must represent 10% of banks' assets compared to their deposits on the banking system's liability side. That is commercial banks, not this. This is Federal Reserve. So this dark green, the vault cash and the reserves, they are their assets. They can represent no more than 10% of demand deposits outstanding for banks. That's the typical ratio that's quoted. Of course, the Federal Reserve doesn't know that. They don't know what it should be for a city bank or a country bank or a state bank or whatever it might be. But that's the number that's thrown around a lot. Nonetheless, those are called reserves. All right, and now I'm showing you the system-wide number of bank reserves, which, as we know, exploded after 2008. So where reserves used to be a very small number, 5, 10, 20 billion, by already January 2009, reserves are $850 billion. So what is this interest on required reserves figure? Well, this is Ben Bernanke telling the system that, don't worry, we're going to credit you with a good asset, that is reserves. We're going to buy off your bad assets, which in this case was mortgage-backed securities primarily. So we're going to buy off the mortgage-backed securities that were guaranteed by Fannie and Freddie. And we are going to just continue on. But you know what? We don't want you to go ahead and lend on these reserves. We don't want you to do that. So we're going to put this interest on required reserves. And that was 1.4%, just under the Fed funds target, which is what the Fed wants the banks to lend to each other. And we'll talk more about the different levels of this as we go on in future videos. But as I've talked about in the last video, banks were well under the target here at this point. October, November 2008, well under. You see that at this point. November 5th, 2008, 0.23% was the effective Fed funds rate. That means banks were actually lending at this rate. That means they were telling Ben, please give us some of that liquidity. You know, we're not going to take much risk here. We need you to give us more liquidity and thus lower interest rates, so everybody is on an even playing field with very, very low risk. And indeed, he complied after the Madoff debacle. Nonetheless, here we have this interest on required reserves at 1.4%. It's a little bit below, and you see it doesn't take but 5 weeks to just match the Fed funds target of 1%. So that's interesting. Now, they also had another tool, as Ben Bernanke called it, that was interest on excess reserves. This is this slightly less dark red. Apologies if it's too dark here, but that's right here, the lower number you can see in the tooltip. What is the interest on excess reserves? At the time that they started this tool, it was 0.75%. Now, obviously, it is lower than the interest on required reserves because the idea is, as Helicopter Ben Bernanke said, we are going to give you the liquidity, but we don't want you to lend it right back out yet. It's not safe, so we're going to pay you this 1.4% interest on required reserves. But nonetheless, you're still going to have some excess reserves. If you have that, we'll give you a lower interest rate okay, if you want to hold it with us. But since this is excess reserves, the idea is that you would still want to loan out funds to the economy to try to make just a little bit of a return, and they can be hopefully safe investments. But the idea is that, we're going to pay you a little bit less, so you'll still engage with lending credit to the economy. That's what they're telling the banking system. And so you see again, here, it's very interesting. The interest on excess reserves, it's the lower red line. It falls with this rate cut here on October 29th, which was just a few days after the worst stock market day, October 24th in decades, where around the world stocks are falling at 10%. Just lasts a couple more weeks though, and then they decide, let's combine them all. So at this point, the Fed funds target, the interest on required reserves, and the interest on excess reserves are all 1%. So this idea of sort of tooling with the economy, being very scientific, went out the window after 5 weeks. And now they're all at 1%. But again, that wasn't enough. As we saw, banks were still clamoring for more liquidity. As you can see, the Fed funds effective rate, the yellow/orange line there, is much lower. At this point, just before the rate cut, it's 90 basis points lower. Okay, the centralized central banking system was saying, okay, 1%, that should be the bank rate for lending with each other. And banks were saying, no, we're lending at 0.1%. We don't care about what risk you want us to take. We're lending with each other at 0.1% for our base rate. And then Uncle Ben said, okay, fine, I will comply. I'll add more liquidity, more reserves, buy more bad assets from your books. And I'll take down this interest on required reserves, interest on excess reserves. And now you see, I didn't talk about this as much yesterday. The Fed funds target rate, there's now a lower bound and an upper bound. They were trying to be, again, scientific here by creating this lower and upper bound. You can't even see the upper because it's covered by all these interest on required and excess reserves. I'll take it off. Take off required, excess. Now you can see it, the blue line. They started it here. So they have this upper bound and lower bound for the Fed funds. Just because they wanted to make it seem like they weren't being too easy and taking rates to zero. That's why they put this upper and lower bound. Nonetheless, you can see, maybe it did its job, maybe not. The Fed funds did not crash to zero. It stayed between this range. And this is what they decided to do during the crisis. So let's put on the interest on required reserves, interest on excess reserves back. Again, this is basically all of the reserves that you see here in green, the 850 billion or so at this time. The Fed is saying, don't worry about even lending with other banks. Don't even worry about lending those reserves into the economy. Park them here with us. Let's take some time to cool off. We will pay you interest. And so they put that rate at the upper bound of the Fed funds target. So at the time, all of those things were 0.25%. That is the Fed funds upper target, interest on required reserves, and interest on excess reserves, 0.25%. And of course, they had the Fed funds target on the lower bound at 0%. All-time lows in the history of mankind right here, as far as systemic interest rates go. All right, that's really all I wanted to show you for this video, because there's a lot to still digest here. They kept this, right, for many, many years, okay? And QE1 was what I just showed you. The reserves did end up getting, to $1 trillion by 2010. QE2, 2011, reserves get up to $1.7 trillion. QE3, reserves get up to $2.8 trillion. The balance sheet itself keeps growing because physical cash grows as well, $4.4 trillion. And this was the ZIRP, or zero interest rate policy environment that the world went on with during these initial QEs for many, many years until 2015. And here they decided to normalize it. Notice the interest on required reserves and the interest on excess reserves. Let's see how it looks compared to the upper bound as we climb up. A little bit different for a second there. The upper bound goes a little bit quicker, but the interest on required and excess reserves is the same. Again, upper bound raises a little bit quicker, still the same. Here, upper bound raises a little bit more. They decided to be a little bit cute with it. Okay, let's take the upper bound to 2%, but the interest on required and excess reserves only to 1.95%. Let's see how that goes. Here they went to 2.5 for the upper bound, 2.4 for the interest on required reserves. And interestingly, at this point, you see the Fed funds by 2019 actually get a little bit above the interest on required reserves and interest on excess reserves. But that's where I want to leave this video because there's so much more to talk about. This attempt right here, and if you said that the Federal Reserve was printing money at this time, you would be correct if you talked about physical cash. But if you talked about the main printing press, which is the digital reserve account, the master account that each bank has with Fed, you would be incorrect. You can see reserves are flat to moving down here. The Fed is not buying as many assets as it used to, and they are trying to target higher rates because of those actions. So we get all the way to July, summer of 2019, and then more things start to happen. I will tell you what in future videos. Thanks for watching.